Welcome to Talk Tickers, where we break down the latest earnings calls. Today, we're diving into Middleby Corporation's third quarter 2025 report. And let me tell you, this was a quarter with a lot more going on under the hood than the headlines suggested.
So you see this massive earnings beat, right? Almost 17%. The stock rips higher pre-market and you'd think it's going to be a great day. But then, bam. By the closing bell, it was in the red. So what happened? What's the disconnect here between that big beat and the pretty brutal fade? That's what we're going to unpack.
All right, here's the game plan. We'll kick things off with those shiny headline numbers, then we'll peel back the layers to see what spooked the market. After that, we'll get into management's big value unlock plan, check out their guidance for what's next, and then I'll give you our final take on the whole thing.
Okay, let's jump right in. First up, those headline numbers. You know, the ones that got everyone excited right out of the gate. On the surface, the quarter looked fantastic.
So, the big number here, adjusted earnings per share came in at $2.37.
Which, get this, absolutely demolished the consensus estimate of $2.03. I mean, that's a beat of nearly 17%. Just huge. And it wasn't just earnings. Revenue also looked really solid, coming in at over $982 million. That beat the street by a cool $25 million. So you look at all this, top line, bottom line, on paper, it looks like a fantastic quarter. All right, so here's the million-dollar question, right? If the headlines were so good, what was hiding in the fine print that made the stock do a complete 180? And this slide, wow, it just lays it all out. On one hand, you've got that awesome adjusted EPS beat. But on the other, the bad. And it was really bad. The official GAAP results showed a massive $709 million, let me say that again, $709 million non-cash impairment charge. This was all tied to their residential kitchen business. And that one accounting move completely wiped out the operating beat, leading to an official loss of over $10 a share. That's the disconnect right there.
Okay, let's break down where the money's coming from. Commercial food service, no surprise, is still the main engine here. But the really interesting part isn't the percentages, it's the organic growth, or, well, the lack of it. Commercial food service grew just a sluggish 1.6%. But look at the other two. Residential actually shrank a bit, and food processing, it fell over 5.5%. Not a great look for underlying demand. And that weak demand story flows right into profitability, which was, a huge point of concern for investors on the call. The adjusted EBITDA margin got squeezed pretty hard, dropping 260 basis points from last year. Why? Well, about 12 million of it was from tariffs, and they also pointed to a tough sales mix. And here's a big one. Management specifically called out that things are getting soft with their big quick service restaurant customers, the big fast food chains. That's a major headwind for their core business.
So you've got all this pressure. What's management going to do about it? Well, let's see how this builds into their new strategy. They're definitely not just sitting on their hands. They're out there pitching this big, multi-part plan to try and unlock what they believe is a ton of trapped value in the company. And the CEO, Tim Fitzgerald, he was super clear on the call. He basically said, hey, we think our stock is way undervalued, and we are taking big, deliberate steps to fix that. You can't get much more direct than that. So what are these steps? Well, their plan really comes down to three main things. First, they're going to spin off the food processing business as a separate company, tax-free. Second, they're putting the residential kitchen business under the microscope, a formal strategic review, which could mean they sell it or spin it off too. And third, they're getting really aggressive with share buybacks. And when they say aggressive, they mean it. They've already bought back over 6% of the company's shares just this year. And going forward, they're aiming to reduce the share count by 6 to 8% every single year. That's a pretty powerful commitment. But, this whole grand plan doesn't happen in a bubble. We've got to look at the here and now. So let's check out the guidance management gave, because it reveals a pretty cautious outlook that probably added to why the stock sold off. This table is really interesting. It shows their guidance for the next quarter and the full year versus what analysts were expecting. And you can see this weird split, right? The revenue guidance is a little below what the street was hoping for, but the earnings per share guidance is actually a little above.
So what does that tell us? It's a classic signal. They're basically saying, hey, we don't expect sales to be amazing anytime soon, so we're being cautious there. But we're so confident in our cost controls and our buybacks that we think we can still beat earnings expectations on those lower sales. It's a bet on efficiency over growth, at least for now.
And that cautious outlook makes sense when you look at the headwinds they're facing. I mean, these are pretty significant. Tariffs are still a huge drag. We're talking $150 million a year. That pressure from the big fast food chains, that's not going away. And then there's the big one, execution risk. Pulling off these complex spin-offs and sales, it has to be done perfectly, and that's never a guarantee.
Okay, so we've got the beat, the impairment charge, the new strategy, the cautious guidance. What does it all mean? How do we wrap this all up into a clear thesis? Well, here's our call.
This timeline of the stock price on earnings day, it just tells the whole story perfectly. You see that big pop pre-market? That was the excitement over the adjusted numbers. But then, as the day went on and investors really dug into the details, the huge impairment, the margin pressure, the soft guidance, you just see it bleed out all day long to close in the red. It's the whole quarter's narrative in one day of trading.
So, putting it all together, we're initiating coverage with a market perform rating. Why? Because this is a classic show-me story. The potential catalysts are really clear, right? The spin-offs, the buybacks, that can unlock a lot of value. But the risks are just as clear. So for us, the risk and reward seem pretty balanced right here. They need to prove they can execute.
Now, for a trade idea, if you want to play for that potential upside but you want to keep your risk in check, here's an idea. You could look at a long-dated, wide bull call spread. Basically, it's an option strategy that lets you bet on the stock going up, but it strictly defines your maximum loss. By targeting it out to the first half of 2026, you're giving the company time to actually execute on those spin-offs. It's a way to participate in the value unlock story without betting the farm.
This is not financial advice.